Welcome to Global Experts Network Learning Platform. Today we begin Module 6, Fixed Income Investment Analysis. While equities often grab the headlines, the fixed income market is actually larger and provides the essential foundation for global finance. In this module, we will master bond fundamentals, pricing formulas, and yield measures. We'll then explore yield curve analysis and the critical concept of interest rate risk, including duration and convexity. Fixed income knowledge is essential for every serious investment professional. So what exactly is a bond? At its core, it's a contractual promise. The issuer borrows capital today and promises to repay the principal plus interest over time. As a bondholder, you are a creditor, not an owner. Bonds are defined by their face value, coupon rate, and maturity date. We see a vast diversity in the market, ranging from government treasuries, the bedrock of risk-free assets, to corporate bonds, mortgage-backed securities, and even sovereign debt from emerging markets. To evaluate these securities, we must understand yield. But yield isn't just one number. There are multiple ways to measure return, each serving a different analytical purpose for the portfolio manager. We look at current yield for simple income, but yield to maturity is our most comprehensive measure, representing the annualized IRR if held to maturity. For callable bonds, we must also consider yield to call, as issuers may redeem early if interest rates fall significantly. How do we determine the fair price of a bond? It all comes down to the present value of all future cash flows. Understanding this formula is the first step toward professional bond valuation. The pricing formula sums the discounted periodic coupons and the discounted face value. A critical rule to remember: when the market's required yield is higher than the coupon rate, the bond trades at a discount. If the required yield is lower, it trades at a premium. This brings us to the single most fundamental concept in fixed income. Bond prices and yields move in opposite directions. When yields rise, prices fall, and you must understand the curvature of this relationship. The price-yield curve isn't a straight line, it has convexity. This means prices rise more when yields fall than they fall when yields rise by the same amount. This asymmetric benefit is a key tool for portfolio managers seeking to optimize their return profiles. While YTM is a single discount rate, sophisticated analysts use spot rates to value bonds more accurately. A spot rate is the yield on a zero-coupon bond for a specific maturity, the pure cost of money. By stripping coupon bonds, we derive the spot rate curve. We then analyze the overall yield curve, plotting yields against maturities. Whether it's normal, flat, or inverted, the shape of the curve provides critical signals about future economic growth and expected interest rate cuts. Beyond interest rates, we must analyze credit risk. Credit ratings assess the probability of default, and the spread over the risk-free rate is how the market prices that risk. From AAA-rated giants to high-yield speculative bonds, each category carries a different risk-return profile. We use credit spreads to measure the extra yield demanded for taking on this credit risk. Understanding fallen angels and investment-grade boundaries is vital for bond selection. Now, let's talk about the primary measure of interest rate sensitivity: duration. It tells us approximately how much a bond's price will change for a 1% move in interest rates. Macaulay duration is the weighted average time to receive cash flows, while modified duration directly estimates price sensitivity. If yields rise by 50 basis points, a bond with a duration of 7 will lose approximately 3.5% of its market value. Duration is your first line of defense in risk management. But duration is only an estimate. To get the full story, we must add convexity. We also need to manage reinvestment risk, the uncertainty that coupons won't be reinvested at the same high rates. Positive convexity improves our price estimate for large yield moves. Reinvestment risk is especially critical in falling rate environments. While zero-coupon bonds eliminate this risk entirely, other investors use duration matching or immunization to protect their portfolios against these fluctuations. In practice, how do we manage these risks? Institutional investors use strategies like immunization, laddering, and barbells to protect value and generate steady cash flows. Immunization matches asset and liability durations to cancel out price and reinvestment risks. We also use barbell strategies to benefit from both short and long maturities, or laddering to reduce reinvestment risk and provide liquidity. These are the tools of the professional bond manager. The fixed income market is truly global. From the massive U.S. Treasury market to the growing bond markets in East Africa, understanding the primary issuance process is key to entering these spaces. The global bond market exceeds $130 trillion. Entering this market involves a structured process, from mandate and rating to the roadshow and final pricing. East African markets are seeing significant growth, with domestic government and corporate bond issuances becoming increasingly important. We have covered the essentials of fixed income, from the simple mechanics of a bond to the complex strategies used by central banks and pension fund managers. Mastering duration, convexity, and the yield curve gives you a powerful edge in investment analysis. Thank you for learning with Global Experts Network. Please subscribe to the SNB Experts YouTube channel for more advanced insights. Goodbye for now, and I'll see you in Module 7.